You pay your credit card in full. Every single month. Never late. Never over the limit. You think you're doing everything right. So why did your credit score just drop 40 points? Stay with me, because the answer is going to make you angry. And by the end of this video, you'll know exactly what to do about it. Meet Sarah. 29 years old. Marketing job. Good salary. Sarah was proud of one thing: she never carried a balance. Every month, on the same day, she paid her credit card down to $0, zero debt, zero stress. She thought that was the golden rule of credit. Then she applied for a car loan. The bank pulled her credit score, 612. Sarah stared at the screen in shock. Her friend, who is always late on payments, had a score of 740. How is that even possible? That question is about to change how you use credit forever. Here's what nobody tells you about credit scores. The credit bureaus don't care if you paid your balance. They care what your balance was the moment your statement closed. Let that sink in. Sarah paid her card off, but she paid it off after the statement date. So when her bank reported her balance to the credit bureau, it showed almost the full limit. Not zero. The system didn't see responsible. The system saw maxed out. And that one number, called your credit utilization, controls almost a third of your entire score. But that's only the first mistake. The second one is worse. And most people are making it right now without knowing it. Some people go even further than Sarah. They pay their balance off before the statement even closes. Sounds smart, right? Zero debt reported, zero risk. Wrong. If your balance shows as zero every single month, some lenders' systems interpret that as inactivity, like the card isn't really being used at all. And an inactive card can quietly get its credit limit reduced, get flagged as low engagement, or in worst cases, get closed for non-use. If your card gets closed, your available credit drops. And when your available credit drops, your utilization percentage instantly spikes. You didn't spend more money. You didn't miss a single payment. But your score just fell off a cliff. Sarah didn't know this. And in 3 weeks, it was about to cost her the car she wanted. Here's where it gets even more painful. Credit scores aren't updated in real time. They update on a delay, sometimes 30 days, sometimes more. So Sarah could fix her habits today and her score might not reflect it for over a month. She needed the car loan in 2 weeks. She didn't have a month. She had 14 days. If you've ever needed good credit fast, for an apartment, a loan, a job background check, you already know this feeling. The system is working against your timeline. And most people find out the hard way, like Sarah did, when it's almost too late. But here's the twist. There's actually a way to move the number faster than the banks want you to know about. Let's break down what really controls your score in order of power. Number 1 is utilization. Not your balance today, but what was reported on your statement date. This is the one almost nobody checks. Number 2 is payment history, worth about 35% of your score, and it's the only part where never missing a payment truly helps you. Number 3 is length of credit history. The longer an account stays open and active, the more it helps you, which is exactly why closing old cards can quietly hurt you. Number 4 is credit mix. Since having a couple of different types of credit shows lenders you can handle more than one kind of debt. Number 5 is new credit inquiries, where every application dings you slightly, and it adds up if you apply for too much, too fast. Sarah was acing number 2. She was quietly failing number 1. One mistake was erasing all her good habits. Sarah called her bank in a panic. A rep gave her one piece of advice that changed everything. "Don't pay it all off before the statement closes," the rep said. "Let a small balance report, then pay the rest off before it's due. Not zero, not the full limit either. A small, visible number." Experts generally point to keeping reported utilization under 30% as good and under 10% as excellent, never zero and never close to the max. So Sarah changed her strategy. She let about 8% of her limit show on her statement. Then she paid the entire thing off before the due date, so she still paid zero interest. Same habit. Same discipline. Completely different result. But would it work in time? She only had 14 days left before the loan decision. This is the part nobody shows you in finance videos, the waiting. Sarah didn't get an instant fix. She had to sit with the uncertainty. She checked her score app every single day. Day 3, no change. Day 7, no change. Day 10, still 612. She started to panic. Had the bank rep been wrong? Then, on day 12, 2 days before her loan decision, she opened the app one more time. The number had moved. But not by a little. 657. A 45-point jump in 12 days. From one adjustment. No new income. No debt paid off in some dramatic way, just the timing of what got reported. It wasn't enough to match her friend's 740. But it was enough. The loan officer approved her application 2 days later at a noticeably better interest rate than she would have gotten at 612. Over the life of that loan, that single change in reporting timing saved her real money. Money she almost lost because of a habit she thought was perfect. And here's the part that should worry you. Sarah isn't rare. This mistake is one of the most common ones in the entire country, and almost nobody talks about it. Why doesn't anyone tell you this? Because pay your balance in full is technically good advice, it's just incomplete. It's the kind of advice that fits in one sentence, so it's the only part that spreads. The real advice, the timing of what gets reported, takes more than one sentence. So it gets left out. And millions of people are quietly capped at a lower score than they deserve for a habit they were proud of. Now you know the missing sentence. Here's your action plan. Find your statement closing date, not your due date, because they're different. A few days before that closing date, check your balance. Let a small amount report, somewhere around 5 to 9% of your limit. Pay the full balance off before the actual due date so you never pay interest. Repeat that every single cycle and don't let any card go completely unused for months at a time. That's it. Same discipline you already have, just redirected. If this is the first time you're hearing this, you are not alone. And now you're ahead of almost everyone still making Sarah's exact mistake. If this helped you, hit subscribe, because next week I'm breaking down the credit myth that's even more common than this one, and it's costing people thousands on their next home or car loan. Drop a comment, what's your current score? Let's see how many of you are sitting on a number that's lower than it should be for a habit you thought was perfect. See you in the next one.